Welcome back to Global Macro Pulse. It is Tuesday, February 3rd, 2026. If you are staring at your terminals right now, you are seeing just a sea of red that we haven't seen in a generation.
Not in the generation.
We are looking at one of the most violent 48-hour periods in asset history, and frankly, if you're not hedged, you're hurting.
Hurting is an understatement.
Yeah.
I mean, this is a historic flush. I'm looking at the metals board right now, and the numbers are they're staggering. Silver crashed 36%.
36%.
In one session.
In a single session. We have not seen a daily drawdown like that since 1980. And gold just gave up, what, roughly 10% after looking like it was going to break the sound barrier?
Oh, it was parabolic.
We were at spot prices near $4,600. Futures were pricing in $5,500. And then snap. The liquidity just vanished.
It's a liquidation event, plain and simple. But we need to look past the price action for a second and talk about the catalyst, because the narrative has shifted so fast it's giving everyone whiplash. This is the Warsh Shock. It absolutely is. We've been speculating for months, but President Trump finally dropped the hammer, nominating Kevin Warsh to replace Jerome Powell.
And the market did not wait.
Not at all. It repriced the entire forward curve in, what, 15 minutes?
Let's dig into that, because on the surface, a new Fed chair nomination shouldn't cause a 36% crash in silver. But this is all about what the market was pricing in before the announcement.
Exactly.
We were trading on the banana republic thesis.
That's the perfect way to put it. I mean, let's look at the data from just 2 weeks ago. You had the Department of Justice opening a criminal investigation into a sitting Federal Reserve chairman.
Over renovation costs. It was absurd.
Absurd. But the market read that loud and clear. Central bank independence is over. The algorithm was simple. If the administration can bully the Fed chair with subpoenas, they can force rate cuts. They can monetize the debt.
And that's why gold went to 4,600.
It was a sell America, get me out of the dollar trade. Pure and simple.
And then Friday happens. Trump picks Warsh. Now, I've followed Warsh's career for a long time. This guy is... he's not a dove. He's not a political lackey.
Not at all. He's a former Fed governor, a Morgan Stanley guy.
Yeah.
Historically, he is a hard money hawk. He hates quantitative easing.
Hates it.
He's been writing op-eds for years criticizing the Fed's balance sheet expansion. So the market looks at this and goes, wait a minute, this guy isn't going to print us into hyperinflation.
He's going to defend the currency.
And you saw the reaction instantly. The dollar index just ripped higher. Best single day since last May. Real yields spiked.
But hold on, let's play devil's advocate here. Trump loves the stock market, right? He measures his success by the S&P 500. So why would he nominate a guy like Warsh who is likely to keep rates higher?
That is the trillion-dollar question. I think the market is betting that Warsh just brings credibility back to the institution, that Banana Republic risk premium had to come out of the price. If the Fed is independent again, you don't need to hoard gold.
Okay, that makes sense.
But the speed of this move, this wasn't just people changing their minds. This was a forced liquidation.
Right. Let's talk about the plumbing. Because you don't get a 36% drop in silver just from sentiment shifting.
No, this was mechanical. We saw the CME group raise margin requirements on precious metals right as the volatility started to spike.
And for our listeners who aren't trading futures, what does that mean in simple terms?
It means you're leveraged 10 to 1 on silver, because it's been going up every day. Suddenly the exchange says, it's too volatile, we need more cash collateral. You don't have the cash.
So they sell your position for you.
They automatically sell your position. It doesn't matter what you believe about the long-term value of silver, you are a forced seller.
And when you have thousands of leveraged longs all rushing for the exit at the same time, you get
a vacuum, exactly. There's just no bids. And the smart money, they can smell that blood in the water. There is significant data flowing through the tape suggesting JP Morgan closed out a massive short position, rumored to be around $10 billion in notional value, right at the bottom of this flush.
So banks clean up, and the retail trader gets carried out. Tale as old as time.
A tale as old as time.
But here is where it gets really complicated. We have this hard money nominee in Warsh, presumably to fight inflation. But on the fiscal side, the government spending side, we have the absolute opposite happening. We need to talk about the OBBBA.
The One Big Beautiful Bill Act.
Yeah.
Passed last July. But we are only now seeing the implementation hit the economy. And the numbers, I mean, they're staggering.
What are we looking at?
The CBO is estimating this adds $3 trillion to the debt over 10 years. And frankly, that is a conservative estimate.
$3 trillion.
If these temporary tax cuts become permanent, you are looking at $5 trillion. And it's not just the top-line number, it's the structure. This isn't building bridges. This is a direct injection of cash.
No tax on tips, no tax on overtime.
Think about the behavioral economics of no tax on overtime. If you are an hourly worker, your marginal tax rate on that extra hour just went to zero. It's a massive incentive to work more and spend more.
It's highly inflationary. And the deductibility of auto loan interest, you're basically subsidizing consumer debt.
You're pouring gasoline on a fire, you're encouraging people to buy more expensive cars, take on more leverage, and then you have the Trump accounts, tax-deferred savings for children. The immediate effect is a massive fiscal pulse.
So connect the dots for me. We have Warsh, who wants to stop inflation, taking over the Fed.
Wow.
And we have the OBBBA, which is driving inflation, running full steam ahead.
It's a collision course. It is the irresistible force meeting the immovable object. Warsh is going to look at the data coming out of OBBBA, and he's going to say, I can't cut rates. I might even have to hike.
But the Treasury is issuing massive amounts of debt to pay for all this. Who buys that debt if the Fed isn't doing QE?
The private market has to buy it, and they're going to demand a higher yield to do it.
Which is why we're seeing the 10-year Treasury pushing, what is it now?
Pushing 4.28% and looking like it wants to break higher. The bond vigilantes are waking up. They're saying, if you are going to blow out the deficit to 7% of GDP, we need to be paid for that risk.
It just feels like we are entering a regime of extreme volatility. You have the executive branch flooring the gas and the central bank slamming the brakes.
And usually when that happens, something breaks. And that's just the domestic picture. We haven't even touched the geopolitical tape.
Right. If you showed me the geopolitical headlines from the last week without the price of gold, I would tell you gold is at $6,000.
Easily. It's a massive divergence. I mean, let's just run down the list. The aftermath of the Venezuela operation.
The absolute resolve operation on January 3rd. U.S. forces physically capturing Nicolas Maduro. That is a precedent that sends shivers down the spine of every unaligned leader in the world.
Massive escalation. And then you look at the Middle East.
Iran is burning.
Reports are confirming over 12,000 killed in protests. The regime is fighting for its survival. And the U.S. has deployed what Trump is calling an armada to the Persian Gulf.
Carrier strike groups, support vessels, the whole thing.
Historically, when you put that much firepower in the Gulf, the risk premium on oil goes through the roof.
And yet, Brent crude is sitting around $66. It's barely moving. Why is the market so complacent on this?
It's the boy who cried wolf syndrome. Traders have heard about the Strait of Hormuz closing for 20 years. It never happens. The algorithm is currently programmed to sell geopolitical spikes because they usually retrace. But I think the market is mispricing the tail risk here.
Big time. And then the curveball that no one had on their bingo card, Greenland.
I still can't believe we were talking about this as a market mover, but we have to.
Yeah.
The administration trying to buy Greenland, getting rejected, and then responding with tariff threats against NATO allies.
It sounds absurd, but the economic implications are real. If you start slapping tariffs on the EU because of a failed real estate deal, you disrupt the entire transatlantic trade architecture.
It's stagflationary. It fractures the Western alliance trade right when you need it most.
So, bringing us back to the gold crash, you have all this geopolitical fire, and yet gold collapses. Your thesis is that the Warsh Shock and the liquidity drain just overpowered everything else.
Yes. In the short term, liquidity is gravity. It doesn't matter if there is a war. If you are getting a margin call, you have to sell what you can, not what you want.
But, and this is the key, but none of the fundamental drivers have changed, right?
Not at all. The deficit is still exploding because of OBBBA. The world is still chaotic. The debt-to-GDP ratio is still heading to 124% by 2034.
Which brings us to the portfolio implications. Everyone listening wants to know, was Friday the end of the bull run, or was it the buying opportunity of the decade?
Well, let's look at what the institutions are doing. The smart money isn't folding. JP Morgan put out a note after the crash. They are maintaining their call for $5,000 plus by Q4 2026.
And they have that stress case model on allocation, right? Walk us through that math.
It's fascinating. They argue that global allocation to gold pension funds, sovereign wealth funds, is historically low, around 3%. If that just normalizes to the 2012 level, which was about 4.6%.
Just a small increase.
A small increase, and the price model implies an upside to $8,000 an ounce.
So even from the highs of 4,600, that's nearly a double. From here, it's massive.
Right. And Goldman Sachs is holding steady at 5,400. Their thesis is based on central bank buying. The People's Bank of China, the Reserve Bank of India. Do you think they stopped buying because Kevin Warsh was nominated?
No. In fact, after seeing the U.S. capture Maduro and weaponize the financial system, they probably want more gold, not less.
Exactly. The weaponization of the dollar trend is secular. A new Fed chair doesn't reverse that. Deutsche Bank is really the only major shop sitting on the bear side, and their floor is 3,900.
So if 3,900 is your floor and 8,000 is your sky, the risk-reward is pretty skewed.
Incredibly skewed to the upside.
Yeah.
But you have to have the stomach for it. If you were leveraged 10 to 1, you're dead.
Yes.
If you own the physical asset, you're just watching the volatility.
Let's pivot to equities before we close out, because while metals were burning, the S&P and the Dow were hitting records.
Yeah, they are purely focused on the OBBBA tax cuts. It's simple arithmetic for equity analysts. Lower taxes equal higher earnings per share.
The Trump trade is alive and well.
It is, but, and I sound like a broken record here, it all comes back to the bond market. That 4.3% level on the 10-year.
What's the breaking point?
If the 10-year yield breaks above 4.5% or heads toward 5% because of inflation fears, the equity valuation model breaks. You can't justify high PE ratios when the risk-free rate is 5%.
And we have a paralyzed Fed until May. Powell is technically still the chair, but he's a hostage. He can't do anything.
We are flying blind on monetary policy for 3 months. Meanwhile, the tax refunds from OBBBA are hitting bank accounts right now. We're going to see a demand shock right when the Fed is unable to respond.
That sounds like a recipe for an inflation print that surprises to the upside.
And if we get a hot CPI number next week, then the bond market will do the tightening of the Fed. Yields will spike, and that could be the pin that pricks the equity bubble.
So if you're an allocator, what's the play?
The consensus among the strategists I trust is, don't chase the equity rally here. It's too dependent on perfection. The gold flush is a gift for the long-term debasement trade. And watch the dollar. If Warsh talks tough, the dollar rips, and that crushes emerging markets.
It's going to be a wild Q1. We have a new regime at the Fed, a massive fiscal experiment, and a world on fire.
And the only thing we know for sure is that volatility is back.
Stay liquid, keep your eyes on the 10-year, and don't get shaken out by the noise. This is Global Macro Pulse.
See you on the tape.
The content presented in this deep dive is for informational purposes only and does not constitute financial advice. Always do your own research or consult a professional before making investment decisions.